Alright guys, so today I want to give you a housing market update. We're going to cover home prices, mortgage rates, and the hidden costs of owning a home that most people completely overlook. But guys, before I do so, in case you're new around here, my name is Nima and welcome to the channel. I'm a corporate executive with over 15 years of experience in both sales and finance. My videos break down complex financial concepts to help you on your financial journey, whether you're just starting out or if you're already a seasoned pro. So guys, let's jump into today's topic, which is the real cost of housing in 2026, and it's bigger than you think. So let's go ahead and begin. Guys, the median home price in the United States right now sits at $429,226 and is actually up about 0.9% compared to last year. Now, I know some of you are waiting for the big crash, and I totally get it, but the data just isn't showing that. Guys, this video is going to break down all of it in a way that actually makes sense because there's a lot of noise out there and I want to cut straight through it. By the end of this video, you're going to have a much clearer picture of where the housing market actually stands today and what it means for your wallet. Okay, so let me just start by addressing the elephant in the room first. Is the housing market going to crash? And I want to be real with you because I know a lot of people are either expecting it to or probably hoping for it. Now, during the last housing market crash, median home prices fell by roughly 30%. And that was a serious, devastating drop that wiped out a lot of families' wealth. But right now, home prices are up 0.9%. And that is not a crash. That is not even close to a crash. So here's the thing. For home prices to crash, you need a lot more supply than there is demand. And that's just basic economics, supply and demand. Right now, there are about 1.7 million homes that are listed for sale all throughout the United States, and that number is actually slightly down compared to even just 12 months ago. So, with that said, supply is actually going down and not up, which is the opposite of what you'd need to see for prices to fall dramatically. Now, maybe you're thinking, okay, fine, but what about a wave of foreclosures flooding the market? And yeah, foreclosures are rising up about 14% year over year. But here's the perspective check. Even with that increase, we are still seeing fewer foreclosures than we saw all the way back in 2005 before the last crash even really got going. And by the way, during that last cycle, it took 5 full years for foreclosures to peak, and then home prices didn't bottom out until 2012. So if you're waiting on a crash to buy, I'm telling you right now, the math isn't really there. So now I'd like to talk to you about mortgage rates, because this is where things really get interesting, especially given everything that's happening in the world right now. We've been hovering around that 6% range on a 30-year fixed mortgage, and the reason for that comes down to something called the 10-year Treasury note. Basically, mortgage rates move with that treasury yield. When that yield goes up, the mortgage rates go up. And when it goes down, mortgage rates follow that same downward projection. And just to let you guys know, we were actually heading in the right direction earlier this year. Rates were slowly easing and people were starting to feel hopeful about getting back into the market. But then, unfortunately, the conflict in the Middle East started, oil prices surged, and inflation expectations shot up again, and that sent this 10-year Treasury yield up higher, which pushed mortgage rates right back up to 6.4%. So yes, a war happening thousands of miles away is directly affecting what you are paying on your mortgage right here in America. And that's not an exaggeration. Millions of people who were planning to buy a house or refinance this year because they've been impacted by this, unfortunately are having trouble doing that. And guys, I want to be straight with you. Even if the war ends and oil prices come down, I cannot promise you that affordability is going to improve in a big way. Because going to war is expensive, and the government is going to fund it the way that it always does, by printing more money, which causes inflation, which keeps upward pressure on home prices for years afterward. The longer this conflict drags on, the more of that pressure begins to build up. Now guys, before I dive into more reasons about the real cost of homes in 2026, if you're gaining any value from this video, I'd really appreciate it if you could smash that like button, leave a comment down below, and subscribe. Your support helps this channel grow, so please guys, show some love by smashing that like button, commenting down below, and subscribing. Alright, now let's discuss the next segment. Okay, so now here's the part of the video that I really want you guys to pay attention to, because this is stuff that barely gets talked about, the hidden costs of owning a home. Most people focus on the mortgage payment, and that makes sense. But there are two other costs that have been quietly exploding that are making homeownership way more expensive than the headline numbers suggest. Since 2019, property insurance costs are up 72%. Property taxes are up 31%. Those are enormous increases, and they show absolutely no sign of slowing down. So think about it this way. Even if mortgage rates fall back down to 5 or let's say 5.5%, which would be great for new buyers, the affordability picture can still get worse if insurance and property taxes keep climbing the way that they have been. You'd be saving on one side and getting hit just as hard on the other side. And with that being said, I'd like to also squash a common argument that I hear a lot. Some people say, well, then it's better to rent than to own. And honestly, if you're planning to move in for 4 years or less, I'd probably agree with you. But if you're renting long term, just understand that your landlord is passing every single one of these rising costs straight down to you in the form of higher rent. So basically, you're paying for it either way. But with renting, of course, you're not building any equity. The home affordability index right now is barely above 100, which means a median income family in America can just barely afford a median priced home. And that's living paycheck to paycheck with zero cushion for emergencies. Now let's talk about where people are actually moving, because this tells you a lot about the real cost pressures that people are feeling across the country. The number one state where people are leaving right now is California, and that's followed by New York and then Illinois. And it's not hard to understand why when you actually look at what's happening in those markets. In California specifically, the combination of sky-high home prices, some of the highest property taxes and insurance premiums in the country, a very high cost of living overall, and significant state income taxes is simply pushing people out. Then you tie in the LA wildfires earlier this year, which made things even worse. Insurance companies have been pulling out of California in large numbers, and the ones still writing policies are changing prices that are completely out of reach for average families. In places like New York and Illinois, it's somewhat of a similar story. High taxes, high costs, aging infrastructure, and residents who are just done with it and ready to go somewhere more affordable. And guys, where are they going? Well, Florida is still the number one destination in the country. More people are moving there than leaving, even though you do hear stories about people leaving Florida too. Texas had a massive wave of newcomers, but is now stabilizing and reaching more of an equilibrium. And here's the one thing that surprises people the most. Even though California as a state is losing residents, the number one city that people are actually moving into is Sacramento. People are staying within California, but trading down from Los Angeles or the Bay Area to somewhere slightly more affordable within the same state, which tells you that the pool of California's job market and lifestyle is strong. People just can't afford the most expensive parts anymore. So let's zoom out and pull all of this together, because I want you to walk away from this video with a clear picture of where things stand. Home prices are not crashing. They're essentially flat, growing less than 1%, and the supply of homes is not surging in a way that would change that anytime soon. Mortgage rates are stuck around 6%, and the path downward got interrupted by the war in the Middle East, which is now keeping inflation expectations high and the treasury yields elevated. The real story is, guys, is the hidden costs. Insurance and property taxes that have gone up by 72 and 31% respectively since 2019, and those costs aren't going anywhere regardless of what happens with interest rates. The home affordability index being barely above 100 is genuinely not something to feel comfortable about. Pre-pandemic, it was sitting at 160 to 170, and that gap represents enormous shifts in what it actually costs to live in this country. Guys, if you are currently renting and waiting for a crash to buy, I understand that instinct completely, but the data is telling a different story. Supply is low, foreclosures are nowhere near crisis levels, and multiple forecasts are projecting home price growth of 1 to maybe 3% this year. If you already own a home, the most important things that you could be doing right now is shopping your homeowner's insurance aggressively, appealing your property tax assessment if you think it's too high, and keeping an eye on that 10-year treasury yield, because when it drops, mortgage rates will follow and refinancing opportunities will open up fast. So guys, that's your housing market update for 2026. And I hope this gave you some real clarity on what's actually happening here. Not the scary headlines that you see on the news, but the actual data. The The market is not crashing, but it's genuinely unaffordable for a lot of people, and the hidden costs are a big part of why that is. The war in the Middle East has now become a housing issue too, because it's keeping mortgage rates elevated at exactly the moment a lot of people were hoping to get relief. And that said, even if things calm down overseas, the inflation that comes with financing a war has long-term consequences that don't just disappear overnight. Migration patterns are shifting, states are competing for residents, and people are voting with their feet when the cost of staying somewhere does not make financial sense anymore. This is a market where you have to be really clear about your own situation, your timeline, your income, your local market, because a blanket answer doesn't fit everyone. I'm going to keep watching all of these trends and bringing you updates on this channel, so make sure that you guys are subscribed so you don't miss any of it. And please drop a comment down below and tell me what market that you're in and what you're currently seeing. I love hearing from you guys because every market is different and your perspective matters, and it helps the community on this channel. And as always, guys, thank you for the support. It genuinely means everything to this channel, and I really, really appreciate you watching this all the way through. I'll see you guys in the next video.